If you ask me today, Hari, are you going to invest in shared mobility? I will say no. We already have businesses like Rapido, like Chalo, that are all in the 300, 500 billion dollar. Imagine today, I would be coming in too late if I'm a 40, 50 million dollar fund. Similarly, I was not investing in EV 10 years ago because I still was not sure that EV is going to experience J-curve growth in the next 3 to 5 years. It's only post-COVID, when the stars have got perfectly aligned, we have better clarity in what's going on. Lithium-ion prices have dropped. Infrastructure is getting built. Government support is there. We think the next 4 to 5 years is going to see tremendous J-curve growth.
Hi, wherever you're joining me, I hope you're doing well. Welcome to India Tech Report, a platform dedicated to chronicling and supporting the growth of India's deep tech and climate tech ecosystems, with the occasional segue into other areas of tech entrepreneurship. I'm Hari Arakli, and this is my In Conversation podcast. And my guest today is Kunal Khattar, founding managing partner at AdvantEdge Founders, an early stage VC firm in Delhi that's well known for backing founders in the EV and mobility sectors in India. Kunal is well known for backing both consumer-facing shared mobility ventures like Rapido and technology-led product innovation startups like Exponent Energy, which is a leader in fast-charging tech in India. In this conversation, Kunal talks about why he expects the EV space to hit the J-curve growth stage over the next 3 to 5 years, and how replacing the overall ICE economy in India is a $1 trillion opportunity. Kunal also talks about how, because technology-led industry shifts can take decades, some promising technologies like green hydrogen, for example, will take time to become mainstream. So Kunal, thank you for doing this. I really appreciate your time.
Hari, thank you so much for having me. It's been a pleasure. Good to see you again.
Yeah. In fact, almost 2 years since I last did an interview with you. And this time, thank you for making time for my little humble podcast. Really thrilled about it.
No, pleasure.
In the industry, of course, you're a very well-known figure and known across the country for backing the mobility startups and in general, doing a lot to build the ecosystem. For a more general audience, I would say, if you can talk a little bit about, maybe a few minutes about how AdvantEdge Founders, is trying to build the EV mobility ecosystem. I guess that's the focus, but in the broader sense, the overall mobility ecosystem in the country, and maybe walk us through some of the most interesting emerging trends that you're seeing, and then I'll have some follow-on questions.
Sure, great. Absolutely. No, it's been a pleasure. Thank you so much again. No, it's been about 10 years now when sort of this fund came about. So this was after my 7.5 years of experience of running Carnation Auto. Once we exited that business, I was trying to figure out what to do. And Mr. Khattar, who used to work for Maruti, called me and he said, Kunal, you can try and build another business, but why don't you do something to create 100 successful founders? So that was sort of the germination of this idea of creating an investment platform, an ecosystem, and help young budding entrepreneurs coming out of college to build successful companies. And this was in 2015. This was when there was again a lot of interest from global investors to come, and we saw Uber entering into India, Ola was getting funded, Flipkart got funded. So then when I started this fund, it was very important for me to answer the same 3 questions that I ask all the other entrepreneurs, which is, where will I have strong founder market fit? How do I create a competitive advantage over other funds? And ultimately, long term, how do I create a sustainable competitive mode? So it was very clear to me that we had to be differentiated from funds that have been around for years and years. And having spent now a lot of majority of my working life surrounded by automotive sector industry leaders, as well as working in the automotive space, we decided to have a sector focused fund. So in those years, we were clear that shared mobility was a theme that is going to scale tremendously. So after seeing how successful Uber and Ola was in raising capital, but one thing was bothering us that Uber Ola chose a four-wheeler as the primary product for India, and we were not clear if that was the right form factor, given that India's income levels were much lower. So we made a list of all the other form factors where shared mobility platforms could be built in an asset-light way, but would be far more affordable to the common Indians. And we said four-wheelers less than 1% of India could afford. So we identified e-rickshaws, two-wheelers, three-wheelers, and buses as forms of transport that are more affordable to the Indian masses. And we backed companies like Rapido for two-wheeler taxis, Sheru for e-rickshaws, Shuttle, Chalo, and Zing Bus were using buses for providing mobility solutions. Now, having built those as successful companies, the next excitement or opportunity we've seen that these commercial businesses, which are in the business of providing mobility solutions, logistics, delivery, and things like that, are accelerating to become profitable. One of the highest cost that mobility and logistics company has is fuel. Um, you know, uh, our country taxes petrol and diesel at almost 120, 130%. So when you want to become profitable, you look at what is in your control, costs are in your control, and your biggest operating cost is fuel. So these are businesses that are looking to transition away from the traditional ICE or the internal combustion engine to EVs, where the cost of the energy is significantly cheaper, and hence you can bring down the cost of operating these businesses. So basically, as a fund, we are now in the process of raising our third fund, where we are going to be focusing on accelerating and transitioning these logistics and commercial businesses using vehicles from the traditional ICE to EVs and doing it in an accelerated way.
I want to digress a little bit in the sense that I want to bring our audience a bit of a flavor of your philosophy, if you will, because in fact, I have always been curious about how you put founders after AdvantEdge and not AdvantEdge Capital or AdvantEdge Venture, or, you know. So I think that also sort of reflects how you look at the work that you're doing, but we want to hear in your own words. You know,
Uh,
give us a
yeah,
sense of that
no, no,
philosophy.
absolutely. I think this is a recognition from us is that when we started this fund, uh, we gave ourselves a North Star metric of creating 100 successful founders. So it was not creating successful businesses or creating unicorns or delivering superior returns or building, solving pain points for customers. We feel that if our North Star metric is creating 100 successful founders, if you do that, everything else will fall into place below that. But it's recognizing that as our North Star metric. I said it's very clear that as a fund, we ourselves are predominantly come from an operating background. For me, I consider AdvantEdge as my fourth startup, not as a fund. I call myself as the founder of AdvantEdge, not really a partner. We call ourselves or all the people who come and work for us as investorpreneurs, not the traditional analyst or principal or vice presidents and things like that. It's a clear recognition that we exist to make sure that the people we partner with, we want to be there for them at all times to ensure that they become successful. So hence that word, founders after AdvantEdge and not partners or venture. I think that culture is what has now become very, very apparent to even people outside. Um, every fund, of course, wants to be thought of as founders first. But I think once you have a North Star metric and the name and titles, we think that it compels us to make sure that that's a priority. And therefore, Everything that we do, uh, we whatever decision we have to take, we have to ensure that all of that leads to ultimately that goal.
And I think just to sort of round out the snapshot of AdvantEdge, I would say folks probably know it less. Certainly in the general audience category, they would know less. That outside of mobility, also you've had some very successful investments. Even I think one or two good exits. Uh, consumer-facing companies and so on. I just sort of wanted to make that observation. Um, and I also wanted to bring in the consumer point, because in this country, if entrepreneurs can build businesses that can serve hundreds of millions of people in the mobility sector, I think you will easily surpass your target of 100 successful entrepreneurs. And to that point, a couple of observations you made in recent times as well caught my attention. One is at the big picture level, you are very confident that there can be $1 trillion opportunity here at the overall sort of level, with all the many different players, from finance to innovation and deep tech. And within that, the small sliver of the last mile delivery electrification, which you think will more or less be complete within the next 5 years. I wanted you to talk about both of those things, sort of they're connected, and walk us through the significance of what all this means.
Sure, absolutely. No, the great point. So we are very convinced that this transition from ICE to EV will create $1 trillion of market cap or value across the ecosystem. This is something what internally we refer to as a Suzuki 2.0 moment, having been associated with Suzuki directly and indirectly. I think we all recognize how important a role Suzuki has played in establishing the ICE or the internal combustion ecosystem in India since they entered back in 1985-87. So prior to Suzuki, India didn't really have an auto industry. Right? Suzuki came and they were very courageous. They came to a country where really they realized that nothing exists. They're going to have to build everything from scratch. So they brought on board, multiple joint ventures, which at that time were unheard of. Today they are household names. Motherson Sumitomo, who also happens to be an anchor investor and a partner with us, was one of these so-called joint ventures. Then you had Sona, Koyo, you had Lumax, Anand, all of these. Look at where these businesses are today. All these joint ventures and all the component companies that were set up to become tier one suppliers to Suzuki collectively are worth probably close to $150-160 billion. India didn't have GMP or good manufacturing practices. Suzuki came in and created a culture of manufacturing. They brought in their Japanese trainers, they sent Indians abroad to work in their factories. They created that whole manufacturing process, which allowed other OEMs to come and set up shop. When they realized that they needed to distribute cars, concept of a 3S dealership was established and expanded. That's the sales, service and spares model, which even today, I believe there are close to 16,000 dealerships across the country. So if you were to value those dealerships on a standalone basis, those businesses today probably with themselves be worth about $150 to $200 billion. Suzuki wanted financing to make car ownership more affordable. They went and tied up with banks. Many banks that grew in the 90s and early 2000s, banks like HDFC, ICICI, recognized that vehicle financing was one of the biggest reasons they were able to scale those businesses, and look at where those banks are today. Similar story played out in the insurance sector, right? Prior to Suzuki, we don't even know if there was a mandate to buy car insurance, but car insurance has become a multi-billion-dollar industry. Then you talk about the after-sales market, which is an area that Carnation was building in. Everything from spare parts, selling certified used cars. Companies like Cars24 and Spinny today are billion-dollar companies in that space. And then finally, so once that ecosystem was created, right, that gave the encouraged other OEMs to come and set up shop, whether it was the Daewoo's and the Opels, and then the Hondas, the Toyotas, and then all of that. I think all told now we have more than 35 OEMs in the four-wheeler space. Then in the two-wheeler space, you had joint ventures of Hero Honda, Bajaj, Kawasaki, TVS, Suzuki, and things like that. So those businesses, OEMs today, are also worth about $100+ billion collectively. And once we had two-wheelers, three-wheelers, four-wheelers, right? So once the ecosystem is there, vehicles started flying off the shelves, people started buying it, personal mobility picked up, shared mobility picked up, Uber was created, Ola was created, energy distribution. We import about $190 billion of crude oil every year. So, companies like Bharat Petroleum, Indian Oil, etc., are all, look at the market cap that they've created. So for us, Suzuki 1.0 was that triggering point where Suzuki came and spent the next 25, 30 years building that ecosystem, and then others were able to leverage that. So sum of parts, the ICE value chain today is worth north of $1 trillion. If we look at that, today electrification is going to disrupt many of those players in those verticals, right? Whether it's the component, whether it's the OEMs, whether it's the dealership, whether it's financing, whether it's insurance, or ultimately the energy distribution. We're going to see a number of new age players come up. Of course, it's going to take time. It's not going to happen overnight. Many of the legacy companies will transition and become leaders and continue to remain leaders, but we think many of them will get disrupted. So in the next 30 to 40 years, if we feel that we will be transitioning fully away from ICE to EV, we will see a duplication of what happened, and we will end up with $1 trillion of market cap getting created. And that's fundamentally what we are doing at the fund. Is in our mind, if we think that transition from ICE to EV can be compared with the California gold rush, we are here to fund the picks and shovels companies, the companies that are going to be building the building blocks on which this transition is going to be held, which are EV component companies, EV OEMs, EV financing, leasing companies, insurance, warranty, reinsurance companies, energy distribution companies, people providing and charging these vehicles in any form factor, whether it's home, public, or on roads and things like that. And that is where our belief is that we will see $1 trillion of market cap getting created in this space again.
Give us some examples. Of course, some companies like Rapido, which has now, of course, become a unicorn, and Exponent is a stone's throw from here. These are now becoming well known, but give us some examples of companies that you have already invested in and which are now, bigger ventures and they're growing and all of that. And also the type of conversations you're now encountering with new founders, the new ideas that they're bringing to you.
Sure. So, we've been around this is our 10th year, and what we've seen is building successful companies in India is a long time. Yeah. Right? We sort of like to talk about that entrepreneurship in India is like a marathon race, but you have to do it in multiple 100-meter sprints. So, and that marathon race is 10 years is too short a time. So I think in that time, we've created category leaders. In fact, we've created 8 category leaders in this space. Companies, of course, Rapido is probably the most well-known and one of our most successful companies that has come out of our first fund. But we were very successful in building companies like Chalo as well, which is digitizing public transportation. In the second fund, we've seen success in companies like Park Plus. We've seen success with companies like Zingbus and, of course, Exponent that you mentioned. I'm very happy and excited about the progress these companies have done. But I think this is day one, probably for most of these companies. These businesses will continue to compound. I think there is a clear recognition that they've built a differentiated product or technology or solution. We have a clear line of sight of strong product market fit, and we are seeing customer adoption and revenue and path to profitability come in as well. So these are all businesses that we've already spent 5 to 6 years for. I think in the next last 2 years, I think a couple of the companies that we have funded and which we're very excited about. One is Moonrider. It's building electric tractors. We feel that transition from ICE to EV of tractors is probably going to surprise a number of our people, the industry. and we are very bullish about that. Phenomenal track record. Both founders come from OEM backgrounds, electric OEM as well as legacy. And we think that there is going to be a tremendous pull for tractors, predominantly because even though fuel, which is diesel, is almost 100 rupees a liter, electricity in many cases for the farming communities provided for free or is highly subsidized. So we think that once people recognize the power of EV tractors and the low operating cost and the high operating leverage that you give, we are pretty confident that if any time in the future, nobody would want to buy a diesel tractor anymore. So which is why we're pretty excited about that. Another company that we've funded was, so I think one of the reasons we're able to identify many of these businesses actually are our clear understanding that in India we're building a differentiated EV ecosystem. We don't like to compare ourselves to America and China. So let's talk about that first. America and China are predominantly 98-99% four-wheeler markets, right? America moves on cars. There is no two-wheeler, three-wheeler, very little buses and trucks. China, similarly, I think developed countries are predominantly four-wheelers. And if you look at India, India is predominantly a two-wheeler country. India is probably the largest market for two-wheelers, for three-wheelers, for buses, for trucks, and things like that. So if we really want to build world-class companies or market world-leading companies in India in the EV space, I feel we should be focusing on form factors where we are already market leaders in the ICE space. We are not market leaders in the four-wheeler space. More importantly, I think electrifying commercial operations is going to be a higher priority for us for two reasons. Number one, even though only 10% of vehicles on Indian roads are commercial vehicles, they consume 70% of our energy and therefore actually contribute 70% of pollution, of vehicular pollution. Who are these commercial vehicles? All the shared mobility players, all the logistics companies, your food delivery companies, your e-commerce guys, public transportation, logistics, freight, intercity travel, etc., etc. Just think about the power of that. You just have to electrify 10% of vehicles. We will not only reduce 70% of vehicular pollution, we will actually reduce and save $150 billion of crude oil imports every year. Just think of the how important and how the magnification of that simple aspect can be. And we feel once you've electrified commercial vehicles, actually commercial vehicles, by the nature of the fact that they are income generating assets for the owners, number one. Number two, they are typically driven 5 to 10x more than personal mobility. Actually changing them from a traditional fuel to ICE to an electric vehicle because of the low operating costs actually gives significantly higher operating leverage to those businesses, which means it will make the entire EV infrastructure highly competitive with high utilization, which will make it cheaper for everybody else in the industry. So, as a thesis, what we are saying is that look, electrifying personal mobility is okay, but if we prioritize electrification of commercial businesses, we will make it much cheaper for others to electrify, number one. Number two, which is more important, is we are able to achieve the end objective with significantly less capital. Because a dollar invested in electrifying public transportation or logistics will see a better return in the initial days than a dollar invested in personal mobility. And ultimately, we will always be a capital deficit country. Interest rates here are very high. So if we have limited capital, it's very important for us to, one, focus on businesses that give you better returns, two, focuses on businesses that have higher operating leverage and have a significantly higher impact in society, both from job creation. Again, commercial vehicles will always be used for business purposes. That means there are people in the lower income groups, people that are dependent on these vehicles for their livelihood. So you're not only making a significant improvement on environment norms, you're also improving income levels of all the people who are driving taxis, delivering parcels, driving public buses, doing intercity travel and things like that.
Just as an aside, I mean, Amitabh at Altigreen, I'm sure you've interacted with him. Are you also an investor in him? No. Okay. He's been making this argument for a long time. Of course, in his case, because he's also building commercial vehicles, it makes sense. But yeah, I mean, is there something that investors and in general the financial ecosystem in the country, do they recognize this well enough?
We've been talking about it for so long. We've been sort of sharing this information, these deep insights, and we are very, very open to sharing all the research work that we've done with all of our fellow investors, because it takes a village to build a successful ecosystem, and we want everybody to be participating in that. So, I mean, we are a small fund on a relative scale. We are not going to have enough, all the capital that's required by any means of imagination. So we really want to be able to partner with larger funds who have larger pools of capital, more global exposure, who have relationships with foreign entities, foreign investors, private equity, strategics, people looking to invest in climate and things like that. If we talk about the fact that we are here to accelerate the transition, I think it's going to happen in a more collaborative way. We don't feel we ever compete with other funds or other partners. We actually want to work with them. We bring certain strengths to the table. Every fund has a different philosophy, a different thesis, a different complementary strength. Some have more capital, some have more international influence, some have access to cheaper credit sources than we do. Ultimately, we want to work together and build this collectively. And that is why I'm very appreciative of the fact that there are many funds now who recognize our area of expertise. And it's because we've partnered with those funds, partnered with our existing, founders are now helping us, mentoring and guiding the younger founders that we are investing in. This ecosystem that we have created, that is getting exponentially, the value of that ecosystem goes every time we add a portfolio company to that. These portfolio companies immediately are able to partner, collaborate, or work with other portfolio companies, and that is snowballing into more and more of this AdvantEdge ecosystem. And I think people within our network are recognizing that as a clear differentiator. And I'm happy to say that with Fund 3, we'll continue to add more and more companies of collaborating and complementary nature with our existing portfolio companies.
Mm-hmm. I do want to ask you about Fund 3, but before that, about the picks and shovels builders. And you've spoken about this before in the sense that these non-glamorous companies, but which are, or businesses rather, which are but absolutely critical to the overall infrastructure development for things to move forward. Can you give us some examples? And again, also give us examples of founders that you are now talking to and the new ideas that they're bringing to. And I'm especially interested in if there are now entrepreneurs who are bringing a lot of deep technology-driven ideas to you as well.
Absolutely. So when we say picks and shovels, so we're not a large fund. I keep saying that. So we have to punch above our weight. And what we've seen is that building B2B businesses require less capital than consumer-facing businesses. Although we do both. Rapido is a consumer-facing business. B2B is more. You have to build better technology, create a competitive edge, but then you go and sell to other businesses. So you don't really need to build a brand as much, but you definitely need to have superior technology. So deep tech OEMs and all typically could be B2B, especially where in the commercial space. So tractors is a B2B business, buses is a B2B business. I think one of the best examples, and I would refer to, and to answer your question, is a company like Exponent. So it's a picks and shovels company, really, when you think about it. I'm not simplifying what they do. After researching many years, talking to every stakeholder, we realized we were able to pick up. There were 3 reasons why many people hesitate to buy an electric vehicle. One was there's a perceived cost difference. People assume electric vehicles are more expensive than ICE vehicles, and they were right to a large extent. Good news is that gap is narrowing now. So lithium ion prices, which you constitute a majority of the value in an electric vehicle, has actually fallen as much as 90% in the last 10 years, 40% just in the last 3 years. So what we're seeing is that number is getting smaller and smaller. Of course, there are other technologies that are improving, that is reducing the value of that battery, whether it's cell chemistry, or energy density, or just charging. So one is cost. Second is range anxiety. Everybody who used to speak to was saying that we have range anxiety because that once in a year when I want to go on a holiday, I don't want to run out of energy. I'm like, okay, fine, that's and hence we need cars with 600, 700 kilometer range, even though I'm driving only 50 kilometers a day. And the third, of course, was behavior. A lot of people were worried that, okay, I'm used to going into an Indian Oil, spending 10 minutes, getting my car tanked up, and then I'm good to go for the next 5 or 6 days. So that with EVs, how will my behavior change? Will I charge at home? Will I have to go sit in a public charging network and spend 2 hours charging? So that was scaring off people. So we said, okay, how do we solve for all these three things? Exponent, when we made him, came back and talked to us exactly the same thing, said, we want to solve for all three. I said, how are you going to do that? He said, well, we've built proprietary technology that can charge an electric vehicle in under 15 minutes. And that's 0 to 100% charged. 20 to 80% top up is less than 10 minutes. The minute you can do that, the size of the battery that you need to put can become half. Now you don't need 600 kilometers, you need a 200 or 300 kilometer battery. Because if it can be charged in 10 minutes, you can charge it easily, right? Number one. Number two, so the prices come down. Number two, range anxiety is gone. If I can charge 10 minutes, I can effectively drive all the way from Kashmir to Kanyakumari and charge it twice a day if I have to. 15-minute charge is a pit stop. It's a bathroom break. As long as the charging networks available, range anxiety has disappeared. Third, a 10-minute charge at an Exponent e-pump is exactly the same behavior as a 10-minute top-up in an Indian Oil can. So now you've solved for all three. And that's one of the reasons why using technology, identifying what the hair on fire problem is, what is preventing us from transitioning from ICE to EV, we went in and solved for that. And Exponent is doing that. But Exponent is in the business of selling energy. And with that, they're prioritizing commercial vehicles over personal mobility. So the logic being that an individual owning a scooter will drive 50 kilometers a day, but a bus driving intercity will drive 600 kilometers a day. So I can sell, the energy that I can sell to a bus is equal to the energy that 2,000 scooters would need. So it's better for me to build for a bus than for a two-wheeler. So with that philosophy, Exponent has built batteries for three-wheelers, passenger and cargo. They're built for buses. They will soon build for four-wheeler commercial use cases and things like that. So we look at these and start with the problem statement first. We go solve for that. Similarly, when we went to Rapido and the founder, and I used to sit on the board there, I asked them, what's preventing you from going electric? And they told us, we don't have the right form factor. What they said was that, look, Ola and Ather are brilliant scooters, but they're not suitable for bike taxi use cases. Our needs are different. I can't have a 3 to 4 hour charging solution. I need a high powered, high capacity bike. So because nobody was building a commuter bike variant, 80,000 to 1 lakh rupee motorcycle, which doesn't have to be fancy, but it's equivalent to a commuter bike segment. We went and invested in Zeno and took the inputs from Rapido and says, okay, what is it that you need? And based on those specifications, they've gone and launched their vehicle, the MRA, today that is beautifully suitable for a bike taxi driver. So things like that. So it's all about starting with an end point, starting with the problem statement or a customer, and then finding the right team to go build in that. That's the virtuous cycle that we're doing, and that is the biggest strength that we have and that we've built.
And Amit's probably doing the same thing with the Yulu Express now with the bigger vehicle. And it'll be interesting to see how, in some way, if all of these moving parts can come together.
So I think your second point was about last mile. Now that's a very interesting thing. What we've seen is with first with the wave of food delivery and now with quick commerce, we've seen the need for efficient, cost-effective, last-mile connectivity, right? Especially for logistics services and things like that. Today, because of the fact that India, by the nature of its business and income levels, have very low average order value, whether it's food, significantly lower than other countries. Right, 100% of these businesses are two-wheeler driven, and we're the largest two-wheeler market. But ultimately, we're going to have to look for solutions that are significantly cheaper than using an ICE vehicle for these. And it's EVs, low speed scooters, low capacity scooters, which were able to provide these solutions. So companies like Yulu and Baz are absolutely perfectly suited to be able to provide solutions at scale for these last mile businesses. This is one of the area that we're very excited about, and we made investments, and we continue to double down on these solutions.
Are you not tempted by these kind of opportunities? I mean, your third fund, you were looking at $60-75 million. Are you not tempted to raise a $200 million fund and, you know, fund a Series C or a Series D?
Again, that's a great question. I'll tell you what we've realized is that the kind of investment philosophy that we have, right? So there's a couple of things where we will always remain a sector focused one. Sector focused funds don't have the luxury of spending or investing across sectors which are experiencing momentum, right? So if you're a sector agnostic fund, when crypto was hot, you got into crypto. When edtech became hot, you got into edtech. When AI became hot, you get into AI. We don't have that luxury. So for us, we're deploying capital in the same sector, whether it's in a bull market or a bear market or it's flat, which is why it's absolutely important for us to understand trends before anybody else does. So I'll explain that. So typically funds, as you know, have a 10-year cycle, right? So you got a 3-year deployment window. What we have been very clear is ultimately in those 3 years that if I'm deploying capital, it has to be in a vertical or opportunities within the mobility sector, which is going to experience the J curve growth in the next 3 to 5 years. If you come in too early, as a fund, we have a concept of time value to money, right? We underwrite a 10% hurdle rate to our investors. Now, if you come in and that J curve growth is 8 to 10 years away, you will deliver suboptimum returns. Similarly, if you come in when the sector is already peaked and there is tremendous FOMO in the industry, you're coming at very high valuations, which is where the Series C or Ds operate in, and therefore again you'll deliver suboptimal returns. And that's why in 2015 we were very clear that we're going to be focusing on shared mobility, because at that point we were at ground zero to build businesses across different form factors in the mobility space, and we invested in all those businesses. If you ask me today, Hari, are you going to invest in shared mobility? I will say no. We already have businesses like Rapido, like Chalo, that are all in the 300, 500 billion dollar. Imagine today, I would be coming in too late. It's not enough for me to make a significant return if I'm a 40, 50 million dollar fund. Similarly, I was not investing in EV 10 years ago because I still was not sure that EV is going to experience J curve growth in the next 3 to 5 years. We actually did make a couple of investments in 2018, and very quickly we realized it's too early. Let's pause. It's only post COVID, when the stars have got perfectly aligned, we have better clarity in what's going on. Lithium ion prices have dropped, infrastructure is getting built, government support is there. We think the next 4 to 5 years is going to see tremendous J curve growth in the EV ecosystem, and hence we are investing in that. So one is understanding and recognizing those opportunities where J curve growth is 3 to 5 years away. Second is, for us as a team, we are great partners in the 0 to 1 journeys. We really want to come in early. We want to be the first institutional investors. We love businesses that have potential but zero revenue. We love businesses where even the product is not. And the reason for that is all of us being operators, we think that 0 to 1 journey is about flexibility, about understanding macro, understanding parallel business opportunities, building products from scratch, understanding customer needs. You need to be fast, you need to be flexible. And that is why we are very careful not to invest in businesses that need to make physical investments or physical infrastructure early on in their journey, because that limits their ability to pivot and be flexible. So till you don't have strong founder market fit, don't take physical assets or fixed cost on their books. That's a learning that I have gone and learned the hard way as well. So we like to outsource and keep variable models across our businesses. We are experts at 0 to 1, which means we need to come in a pre-seed or a seed round, smaller checks, but higher conviction and higher ownership. We think other funds who have larger funds are the right people to come in at a series C or D. That's not us. And that is why we are very closely engaged and interact extensively with founders till they have reached product market fit, or they go raise their first round of growth capital, which is typically a series B or C. At that point, we think those coming in with the 20-30 million dollar checks are probably better partners for these founders to help these businesses now grow from the 10 to 100 journey. So I think just like that, it's very important not only to be sector focused, but also to make sure where is your capability and competency in terms of stage focus. So on the y-axis we have sector focus, on the x-axis we have stage, and we think that's our sweet spot. Mobility businesses in opportunities that will experience J-curve growth in the next 3 to 5 years. We like to come in and partner with founders in the pre-product, pre-revenue, but come in with high conviction and then spend the next 2 to 3 years working very closely with them till they achieve product market fit. And then we like to hand over to those who come in at a later stage. And for us to be able to execute that strategy in the right way, which means that I cannot afford to make more than 3 or 4 investments in a year, which limits my ability to deploy capital. And therefore, for us, a $75 million fund is what we feel is probably the sweet spot. And that is what we want to raise. We don't want to we tell our founders, don't overcapitalize your business till you have strong product market fit. We want to, eat our own dog food. And we also don't want to overcapitalize our fund, because if you overcapitalize, you end up making suboptimum bets, backing suboptimum opportunities, or overcapitalizing businesses. And what we've seen is that those are not great for building successful companies.
What's a quick update on Fund 3? I've already started some drawdown from earlier companies.
We are very close to announcing our first close. We've been very fortunate to have retained 100% of our LPs from Fund 1 and Fund 2. Motherson has come back, has been it's been an honor and a pleasure working with them. They are coming back and anchoring this invest fund again. Hero Group is back. And we've been fortunate enough to raise now and get commitments from some other family offices, including DLF, Sona Comstar. Sanjay Kapoor was very, very excited about it. And you must have heard about the unfortunate, we're very sad to hear about his passing on. But we are very appreciative of the trust he has showed in us. And I've had multiple discussions with him, and we want to honor his commitment and make sure that we are able to live up to what he expected us to do. Apart from that, Mr. Madhusudan Kelaji has also come in and anchored that is going to help and partner with us. We've got a number of other people committed to us.
Is there a conscious decision to, by and large, have your LPs from India? Are they?
Actually, we had a clear strategy that till first close, our focus would be on domestic capital. But between first and final close, we are looking to expand our LP base, and we are in the process now. And I would say we have a pipeline of about 20 to 25 global institutional investors, leading, people who have a high interest in India. Some of them are more climate centric. Some of them are large family offices. So I think that post first close, a majority of the remaining capital will come from foreign institutional investors.
Okay, I have three sort of big picture questions, if you will. Uh, the first one is, I don't know if the question makes sense, but humor me anyway. What would you say might be the UPI equivalent of the EV sector in India?
Actually, it's funny that one of our portfolio companies, Pulse Energy, is actually working on a sort of a UPI equivalent called energy interface. It's the unified UEI, and I'll spend a minute to explain that. Just as UPI sort of democratized payments and created financial renaissance, a revolution, because UPI allowed financial institutions to actually track the real income levels or transactions, which opened a lot of individuals to credit. Because once you had a paper trail of UPI, you knew which vendor was generating what sort of income level, and therefore credit was unlocked and things like that. Energy, just as capital is fungible and transferable, so is energy. We think one of the revolutions in the EV space is going to happen is that just the energy will become a commodity. It will become tradable, which means your the traditional straight line method of energy distribution, where you had a power generation happening, then you had the distribution, and then the last mile. Energy is going to become going to flow in different directions. Individuals will start generating energy, whether through solar, or every electric vehicle actually has the ability to become a virtual power plant. So if you have a car which you are fully charged, and you come back and you have 60-70% of energy left, if you plug into a bidirectional charger, you can actually sell energy back to the grid during peak rates. The other things, what's going to happen now is, traditionally we would pay for our bills based on usage. We're going to start seeing time of day tariffing, where you're going to have to pay more at peak rates and less at off peak rates. And the reason for that is, if as we are moving more and more towards renewable sources of energy, and in India, we're a hot country, predominantly is going to be solar. Solar generates energy during the day, but energy demand peaks at night. So at different point, literally, and the cost of generating a unit of energy on solar, the variable cost is almost zero, right? Because there's no raw material cost, it's just the sun, which means during the day you're probably generating more energy than you need, and therefore the price collapses. And at night, you're not generating any energy. The only energy is coming from your traditional thermal plants, maybe other sources, but now demand is peaking, so you've got to sort of discourage use. So we're going to see this time of day happening. So once energy becomes a commodity, you're going to see trading in different sources. And the unified energy interface is a platform that would be considered to be parallel to UPI, where that was for capital. Here, energy is becoming a commodity, and you're going to see energy getting distributed, commoditized, bought and sold by different players in the ecosystem. So that is what we consider the UPI moment in EV.
So one other thing that I forgot, which I wanted to ask you earlier, and I wanted to at least briefly capture your views as of today on the potential for hydrogen in the mobility context.
Great question again. So here's what I look at. I said, technology, industry changing technology takes decades and decades to come about. So if I were to look at ICE, internal combustion engine, believe it or not, has been around for 120-ish years. I think the Ford Model T was launched around about 1910, 1915, or things like that. So imagine you have a technology that's a powertrain technology that's been around for 100 plus years. You'd be surprised to know electric vehicles have been around for 60 years, 50, 60 years as well. It took EV or electric vehicle technology 50 years to start disrupting ICE. What happens is that once you've got a certain technology powertrain where the incumbents have invested billions and billions of dollars, right? That technology is so well ingrained, the entire ecosystem has perfected it, that to disrupt that, you have to be 10x better than it. From performance, from price, from everything. 2x is not enough. Just to have a technology which is 20% better, 30% better is not going to disrupt a technology where $1 trillion of investment has gone in. So it took EVs 50 years to become 10x better than ICE. So then we saw that disruption happen, and that also happens slowly and not overnight. So if I will take the same sort of continuum, I see hydrogen is there, but it's not significantly better, superior, cost efficient to EVs for it to disrupt EV in any way. So in my mind, I feel hydrogen is where EV was 20 years ago, 15 years ago, 20 years ago. It's going to have to make significant improvements in everything from safety, convenience, price, efficiency for it to threaten EV. ICE is anyways getting threatened by EV. So that's why as a fund, we recognize hydrogen as a potential on an alternative, but we also know that it's not going to have a high level of acceptance in the next 3 to 5 years. And for me, that is the critical point, right? If that J curve is not happening in the next 3 to 5 years, this is a technology we're going to keep an eye out. We think it's probably another 10 to 15 years if we're going to see any adoption. Initially, we're probably going to see some pilot and some adoption happening with heavy vehicles, with trucks or buses. Trucks probably will happen. And that will take about 5 to 8 years for those pilots and things to become stable. Then we can think of started seeing hydrogen being adopted in passenger cars, etc. So in terms of timelines, it's probably a fund 5 focus area for us, but definitely not the next 5 to 6 years.
Okay. For my next question, allow me to make a brief observation, and please correct me if you think I'm wrong. Goshen in Germany is already now piloting solid state batteries. In India, we're still struggling with our first baby steps trying to make battery cells, and so far nothing has come out of it. I mean, the entrepreneurs who've tried have faced tremendous challenges. So in that sense, we are going to lag the advanced economies in terms of just absolute cutting edge technology development and adoption, maybe. So to your mind, what are the big challenges in our ecosystem?
I like to think of every sector now, whether it was IT or automotive, or in this case, cell chemistry or battery technology. It's very, capabilities take time to evolve, right? You cannot go from, writing code or becoming a systems integrator to become an expert in AI. And India has gone through that phase, right? In the 70s and 80s and 90s, we had companies like Wipro, Infosys set up. So initially they were not doing, IP. They were not building products. They were providing solutions. They were helping, multinational companies manage their infrastructure, doing systems implementation, implementing third-party software, which is not a very high-tech job, but ultimately that's what we were able to do because of the capabilities that we had. But over time, you start building and going up the value chain in terms of skill sets and things like that. So that's why we went through that period. And today, we've got the capability and talent to build AI companies or whatever it is. But it's been a 30-year journey. So if I look at EVs also, I think EV as a sector and therefore all the components of EV from a talent perspective or from a capital perspective, we are still at least 15 to 20 years behind America. And like I keep saying, I said, look, it doesn't mean that we have to follow the same process and the same journey that China or America has. We will leapfrog in certain ways. Case in point, whereas China and the US is more four-wheeler centric, I think India will build capabilities on form factors where we are already market leaders, and we will become bigger and better than those companies of for the same products in these other countries because we have a market for it. And China and US doesn't. US doesn't have a two-wheeler market. So we'll build capabilities here. Now we get into deep tech. I think again, since the whole ecosystem is less than 5, 7, 8 years old, I think it'll time for us and we should, temper our expectations to think that we're going to suddenly have breakthrough technology in cell chemistry, in solid state, and things like that. That's because that's what the Americans and Chinese have already been working on, or Europeans have been working on. I think what's going to happen is, I feel, is that if we are building capabilities in different form factor, maybe solid state is not the right technology for a two-wheeler or for a tractor. We've seen pretty interesting things that are happening with companies like Exponent and Moonrider, where they are looking at this whole question of what is the best architecture, the best product. We've looked at oil immersion, we've looked at online cooling, we're looking at different factors of battery technology. With respect to cell, I think we have seen a few interesting companies that are looking at alternate cell chemistry, that are looking at solid state. But the needs of India are very different to those of Europe. Right? We are a far more price conscious market. Our environment is different. Our form factors will be different. Our charging infrastructure will always be different, right? We will struggle with last mile connectivity, with access to power, source of power, quantum thing. So we are a complex country. Our needs are different. Our opportunities are different. I think we shouldn't be blindly trying to say, okay, now they've got solid state, let's build solid state. I think let's build more indigenous technology where we have the capability. Even our quality of manpower and what we are good at is also going to be very different. That's an interesting time, and I think these are nuances that only sector focused funds are able to pick up. And I keep saying, let's not talk about and let's not compare ourselves to China. I think that's doing a disservice to us. We will never be China. We don't want to be China. Let's just build a better India. For me, benchmarking where we were last year, where we are today, where we want to go tomorrow is probably more important than saying China is X, I'm Y. It doesn't matter to me. I just want to build a better India.
That's it for this conversation. For my pick of daily headlines on deep tech and climate tech news from India and around the world, please look for my India Tech Report Daily Morning Brief podcast. To support my work, please subscribe to my free newsletter, India Tech Report. I'm Hari Oakley. Thank you for joining me.